Hi everyone. In this episode, we learn the difference in price and value. They are far from the same thing, but do wind up equal from time to time. Price and value are important because the more they detach from one another, the greater the risks and opportunities are present. Price is what you pay, value is what you get. Let's say, for example, that you are shopping for a new vehicle. You visit the car lot and find one you really like. You open Kelley Blue Book's price estimator and discover fair value is $25,000, but the price at the dealership is $35,000. As with most things, demand drives price. It is no different in the stock market. The market's auction-based pricing mechanism means that rising demand results in rising prices. Factors such as human emotions like fear and greed, unrelated macroeconomic events, or even social media influencers promoting a stock can influence demand and drive price far away from intrinsic value. However, influencing demand does not create more or less value. In fact, value tends to remain somewhat constant. We have not yet learned how to value businesses, but even still, variance between price and value is not as noticeable in stocks as with tangible goods that can be easily researched. Markets are forward-looking, meaning investors strive to price companies in terms of what they may be worth in the future. In many cases, investors are fully aware of the gap between price and value. As we learned in episode 7, growth stocks, for example, often sell at substantially higher prices relative to their value. Let's look at the price of Caterpillar, a farm and heavy construction machinery company, throughout 2020. The COVID-19 pandemic created substantial volatility in the stock market. Many stocks experienced sharp declines in price in late February and early March. As panic set in and prices fell, what happened to the value of Caterpillar? On January 1st, the company's share price opened at $149. On March 23rd, Caterpillar's adjusted close price was near $89. Then, over the next 9 months, shares climbed and ultimately ended 2020 at an adjusted close price of $179. Did Caterpillar's value fall by 40% from January to March and then rise by 100% between March and December? The answer is no. In the near term, volume of buy and sell orders determine market prices, not the value of companies. We look more at the auction mechanism behind markets in Chapter 2. In summary, price is what you pay, value is what you get. In markets, you may find yourself paying more or less than the value of an underlying business. Investors can leverage the difference in price and value to their advantage, which we will learn how in later episodes. And factors such as human emotions, macroeconomic events, and even social media influencers can cause massive fluctuations to price in the near term, even though value does not change. Next time, we look into investing psychology and learn why people are wired to make poor decisions in the stock market. See you soon.